Today I want to talk about how the shorts are losing billions of dollars each and every week in actual real expenditure by trying to push the price down, by kicking the can, and by resetting those FTDs and those swaps. So stay tuned and let's make some money. And now I'm going to dive straight in with the key information. So Biotech Moose tweeted saying, wow, $11.6 billion was spent on AMC options, which is 3.72 times the market cap of AMC. And he asks, does this mean that naked calls are being used to cover FTDs and to provide false locates? He said, if so, it's unsustainable short hedge fund activity. This post on Reddit says traders last week, which I think is in June of 2021, spent $11.6 billion on options contracts tied to AMC, more than on the S&P 500, the QQQ, and Tesla combined. We can see from this chart that in 2021, investors spent over $11 billion on AMC options. Now, this obviously isn't largely retail investors. This is largely those institutions trying to push the price down through the options chain. This $11.6 billion is more than what was spent on Tesla, S&P 500, Amazon, and QQQ options combined. And on top of that, we even know that right now in 2022, the AMC options chain is still stacked and it's still seeing tons and tons of activity. Now, this is really interesting because the activity and the actual volume in the AMC shares has decreased significantly, but yet the activity and volume in the options chain is still very high. This basically means these hedge funds and market makers are still spending billions of dollars every single week in the options chain, taking out those naked calls to cover those FTDs and to provide false locates. So you may have thought that creating these billion synthetic shares through FTX was completely free for these hedge funds, but actually that wouldn't be the case, as they're having to spend money in the options chain on those naked calls or on those married and divorced puts, but they're simply using those FTX synthetics as their locates. They're still not delivering on shares and having to pay those fines, they're still incurring FTDs, and therefore they're still having to hide those FTDs in the options chain. They're just getting those false locates through FTX. So therefore it's still costing them hundreds of millions, if not billions of dollars every single week. Biotech Moose tweeted saying market makers could be writing options contracts and then their hedge fund arm exercises those with shares they don't own, or they use tokenized shares for those false locates. He said that's how they've continued shipping the price down each day, paying themselves with shares that don't exist. And obviously by exercising those options contracts with shares that don't actually exist, they're still paying those premiums and receiving nothing in return because they're using a false locate or a fake share. And that's how they're spending hundreds of millions of dollars, if not billions of dollars, every single week on these fake options contracts. And on top of that, these trading platforms and these hedge funds and market makers now have to stump up significant amounts of additional collateral, considering the APE price has dropped below $1. This live chat with Revolut says that our broker-dealer in the US, DriveWealth, will no longer be able to offer buys on AMC Entertainment and APE due to the increased capital requirements set by the DTC. It says the required amount of capital guarantee is usually around 10 to 15% of the value of a security's holdings on the broker's books. However, this percentage can vary based on stock volatility, and in the case of the above symbols, the DTC has enforced an increase of 250% upon DriveWealth's clearing partners. And therefore, DriveWealth have decided not to take on the large capital probability that comes with this significant increase. If you're not holding any of these stocks, AMC will not appear in search in the trading section. Due to the significant changes in AMC and in APE's price, the DTC is now requiring that these brokers hold an additional 250% capital. This goes to show not only are these hedge funds and market makers spending billions of dollars every single week in the options chain, they're also required to hold billions of dollars more in capital to meet those requirements. If you didn't already know, Moomoo are currently holding their largest ever giveaway for the Christmas period. They're currently holding a $60,000 giveaway sweepstake, and you also get your 20 free shares worth up to $2,000 when you sign up to Moomoo right now using the link in the description below. And on top of that, Qtaner's tweet is saying, I love how in a month, apes have gone from we have a theory to here's the evidence supporting it, to former SEC lawyers say that it's probable, to the mainstream media is starting to cover it. Market makers used FTX to manipulate AMC and GameStop and manipulate the wider market. But not only that, AMC and the Investor Relations Department is aware of the FTX manipulation. And Alexandra Vargas tweeted saying, good morning apes. AMC the company is well aware of the misuse of AMC stock. He said, "Here is John in an email response from my inquiry that I sent him. They are watching. He said, I slept well at night knowing what I know." John Merriweather replied saying, "Thank you for your email. AMC is aware of public reports regarding FTX's bankruptcy. AMC has no affiliation whatsoever with FTX." He said AMC has never authorised any tokenized AMC shares, nor benefited in any way from any tokenized AMC shares. He said any inquiries or complaints related to FTX and any securities associated with FTX should be directed to FTX or the appropriate regulatory authority. Now this is really important because this is basically John Merriweather and AMC saying they did not create these AMC tokenized shares. He said, "We did not authorize the creation of AMC tokenized securities. They were created and misused without our authorization." He's basically said these tokenized securities were created and used by these market makers for their false locates and for their FTD resets, but AMC themselves did not authorize this, and therefore they don't know how many shares were created and how many were sold or used as false locates. AMC obviously doesn't have access to this data, and therefore it's not AMC's responsibility or fault. Obviously the fault lies directly with FTX. But it is positive to know that AMC are indeed aware of these AMC tokenized securities on the FTX platform and how they've been misused by these market makers. And what's really crazy is that Joe tweeted saying as a college student with a financial blog, he received 2 subpoenas following the short squeeze in January of 2021. And he said, meanwhile, Sam Bankman-Fried loses billions of dollars in customer funds and the Feds so far have left him be. But I think this paragraph alone proves that we are indeed right if he was subpoenaed over the short squeeze of January 2021. They clearly did not want information about the short squeeze getting out, therefore subpoenaing his financial blog. This just shows that we are indeed right and market makers are indeed abusing the AMC options chain in order to push the price down. You may remember yesterday how I said that shorts are stuck and can't close out of their positions. The shorts have even said they need retail investors to sell for a new bull market to begin. But what is very interesting is that Market Insider is reporting that just 1% of retail investors want to sell their stocks despite mounting recession warnings. This basically confirms that retail investors are not leaving and retail investors are not selling their AMC and their GameStop shares. It says only 1% of retail actually wants to sell AMC and GameStop, and the remaining 99% are holding strong. But what's interesting is that Meet Kevin has finally confirmed that he is a shill and that he did indeed sell out. Today, Meet Kevin tweeted saying, "I just met Jim Cramer at the launch of my ETF on the New York Stock Exchange. He said it's such an honor to meet my media idol and at the beautiful icon of the New York Stock Exchange." So Meet Kevin actually looks up to Jim Cramer, who we know is in bed with the hedgies and who suggests terrible stock advice. I think it's clear to see that Meet Kevin did indeed sell out to these hedge funds and has become a suit. And finally for today, BlackRock has told everyone to prepare for a recession unlike any other, and has said that what worked before won't work now. This article says the world's largest investment manager has gone all in and says a global recession is right around the corner. And they've said what's more, the financial tricks deployed by central banks in the past won't work this time. It says according to BlackRock, the global economy has entered a phase of elevated volatility and that a recession is imminent due to central banks aggressively boosting borrowing costs to tame inflation. And they still believe that equity valuations, aka stock prices, do not yet reflect the damage ahead. It's basically saying they believe that stocks still have significantly further to fall, which will obviously cause the S&P 500 to fall further, causing those hedge fund liquidations. It says the warnings from BlackRock echo those from Morgan Stanley, Bank of America and Deutsche Bank, which have produced dire predictions, ranging from a 20% stock plunge in 2023 to Goldman's David Solomon seeing a 65% chance of recession. Basically saying the S&P 500 is still likely to fall an extra 20% or maybe even extra 40% or even further. And obviously if the S&P 500 does fall an extra 20 to 40%, it will cause a massive wave of liquidations. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell because that way you'll be alerted when I upload a new video. Cheers.